Example today we looked at in the futures markets, this March contract is at $3.56 per bushel. We've also looked at the cash market price, in this case in El Campo at $4.21 a bushel. So now what we're going to do is we're going to take a look at an example. Now in this example we're going to kind of cover again where we are today in the market and how this relates to a hedge. So today the futures market, by the way, is going to be at what we just talked about a while ago. It's going to be at 3.56. Not only is the futures market important, but the contract month, which was a March contract, it was at the 356. Now, again, as a hedger, you're not involved in one market, but you're involved in two. The second market is going to be the cash market, which again, we looked at El Campo, and the cash market value right now for our current commodity, again, what we know today is going to be the $4.21 that we estimated per bushel. So that kind of sets the data of what we know today. There's a new term, or one you've already been introduced to, but it's called basis. It's the difference between the cash market minus the futures market. So again, the futures market and the cash are two different things. Now they both have values today, but cash minus futures, two different markets, gives us what we call the basis. And for our example, that would be a positive 65-cent basis. So this 65-cent basis, now the positive matters, normally it's a negative, but right now it looks like in our area, the southern area of Texas, corn prices are really high. If you looked all the way up into the Midwest, they were actually a lot cheaper. So right now the corn cash price has been bid up, so you know, with a positive basis in our current situation today. And that'll be important to us as we move on. Okay, so let's take this information from today. What do we know? Cash market and futures of today. And let's look at what we do as an example hedge. Now let's start off with the things that we know. Well, we know there's a time issue. In other words, there's the time of today in September. And then we have this need not till February to actually buy our corn. So there's this time thing that we need to factor in, and that really explains risk. After time, we need to look at the markets we're involved in. The first market is the cash market. Now this cash market is again what we're involved in, and the cash market right now tells us that it's $4.21 a bushel. Now we don't know what it'll be in the future, but that's what we know today. So what about the futures market? What do we know about that? Well, we know we would want a March contract because it'll be the only one tradable, and that's going to be $3.56 as the value. And then we also know, of course, the basis, and that basis is a positive 65-cent value right now. Okay, so when we jump down to February, that's where we're going. That's the risk that we have. We just don't know what that cash price will be. So by not knowing that cash price causes us to make sure that we try to plan for that. So how do we plan for that? Well, we go straight to the futures market and we use it to help us in the cash situation. And in that case, that's going to be where we end up with a March contract trading for $3.56. We become a buyer in that market. Now that's going to put us in what we call a long position. But by taking a buy in that market, we're able to then use that situation to help us as we move through time. And so what do we know? Well, we know what we have now. Now, what do we not know? That's February. We don't know what that cash price will be, but let's just say that as we moved along in the future, February was $5.21. That means that it cost us $1 more to buy that corn in February. Well, if the cash market went up, one thing we can say about the markets is the futures went up too. So what's that March contract trading for now? Well, the estimate would be that it's trading for $4.71 is my example. Now, we don't want to be in that contract anymore, so how do you get out of it? Well, you take a sell position. We started out with a buy. That's a long position. How do you get out? Automatically one way. That's to become a seller. So you sell that to somebody else and you are completely out. The net result is all that matters in the futures market. Well, we started out at $3.56 with a buy, and then in my example, it goes to $4.71, which is a sell. So that's going to mean that we ended up with a profit, and that profit is going to be $1.15 profit there. Now that profit is again what we were after. And so in looking at these two markets, you've got $1 loss. But because of the hedge, we ended up with a $1.15 profit. So overall, you can see we're going to be better off than we planned. That $1.15 is going to cover more than the $1 loss that we had. So actually, this is an example hedge where it turns out really well. Now we continue to work across our table. Cash market and futures market aren't the same. In the example here, of course, is that we're going to look at a basis, and that basis is now going to change. It was 65 cents, but now the basis is going to end up to be a 50-cent value. So that means the basis changed. It didn't stay the same. It changed by 15 cents, and that was the change. Now that basis becomes important to us as well. Okay, so this is the typical table or chart you would build if you're going to try to talk about what happened in a hedge. You need to know the time, you need to know the cash market, you need to know the futures, and you need to know the basis. Now this cash, I'm going to go back to it. This cash price, the very beginning, the very start, when we looked at the market and said, man, we're worried. This is called sometimes the lock-in price. The very beginning cash price that you start off with is called lock-in. The next thing we worry about is really the change in basis. That jumps down and gives us the bottom line. So lock-in and change in basis are very important parts. Now let's go ahead and take a look at the details though. How does net price work? Well, remember, again, we're involved in two markets as we talked. Cash. So what happened in the cash? Well, we had to pay $5.21. Of course, our lock-in is something we just have in the back of our head. The profit from the futures market actually gave us $1.15 back in profit. And so when it comes down to the net, we're going to take the $5.21 that we had to pay and we're going to get it cheaper because we got a profit. That cheaper means that our price came down to $4.06 per bushel. Now remember our target. Our target was $4.21. So how did we end up at $4.06? Well, that's where that change in basis comes into play. So you can kind of do a check. So the check is let me take a look back at lock-in. I tried to lock in $4.21, hoping that the futures market would cover whatever changed in the cash. Well, that change wasn't perfect. It was 15 cents off. So in this case, that means it was 15 cents to my benefit. So really you take $4.21 minus 15, you know, with $4.06. That's how we know we've got the right price to check in. And that explains how that happened. $4.21 is what we started at. We ended up at $4.15. All right, so this is a table. It's important to build this table, and it's important to make sure that you have the concepts of time, cash, market, futures market, basis. That gives you all the tools you need, and then you go ahead and focus on the results. That dollar that it cost us more got paid by the profit. That doesn't always work that way, but that's the net result here. That actually is what also allowed the 406 to happen. Really, the 421 was what we were hoping for. We were better because of the overall change. All right, well, hopefully this example has given you a little bit more background in the futures market and the concept of the cash and the futures, I should say, working together. And that's really the concepts of a hedge. Now, my hedge example is just one way that it could work out. If you were a seller, everything would be the opposite. Where a buyer, everything was this way. Seller would be, of course, the opposite. I've got a situation where the futures market helped me quite a bit. You could have a situation where the futures market didn't help you as much, and so you can end up with a few variations. However, the concept is the same. Laying out that table, making sure you've got the time concepts right, where cash price started and where futures project prices started, and then understanding that basis. If you get that correct, everything else I think gets easy. All right, well, hopefully this gives you, again, a little more insight into the futures and cash markets, especially with the concept of hedging. Thanks.